Okay, so welcome again. In this case, I have the honor of introducing Jon Boyar. Jon Boyar is the director of the Boyar Value Group, which is formed by Boyar Asset Management, a boutique company of investment advice registered with the SEC, and Boyar Intrinsic Value Research, a company of institutional values research that's been continuously publishing asset analysis focused from 1975. He's also a contributor to Forbes.com and host from the World According to Boyar podcast. For me, it's really a pleasure. I had the opportunity once of interviewing Jon, and his view is super interesting. And actually, his firm, it's a legendary firm in Wall Street. So I think this is gonna be a really great presentation, and I hope you guys enjoy as much as I'm gonna do. Hi, Jon. How's it going?
It's going great. Thank you so much for having me. I wish I could be doing this in person, but obviously I'm stuck in New York due to coronavirus. But hopefully next year.
Yes, that's it. We wanted also you to come, but okay, this is understandable. This year is weird for all of us, so okay, let's do it this way. That is also new for all of us, but it's also interesting. So let's do it this way. So if you want, Jon, go ahead with the presentation, and then we will go through the Q&A, okay?
Absolutely, and again, thank you.
Okay.
So I just, first, I want to thank the entire Zonavalue organization for inviting me to participate in this fantastic event. While I'm recording this in New York due to the coronavirus, I truly hope in the future to be able to participate in person. I'd also like to thank the entire Mafre team, who have been fantastic partners. As you may know, earlier this year, we partnered together on the Mafre US Forgotten Value Fund, which is a UCIT. And our team is extremely proud and excited about this fantastic opportunity. In today's presentation, I'm really going to do three things. One, I'm going to give a background on the Boyar Value Group. Two, I'm going to discuss how we identify intrinsically undervalued companies. And three, I'm going to talk about two companies that are presently in the Mafre US Forgotten Value Fund that we believe are attractive investment opportunities. So here are the usual lawyer disclaimer languages. In the US, we have a legal problem where people sue for everything. So here's our disclaimers. And so who are we? Who is the Boyar Value Group? The firm was founded by my father, Mark, in 1975 to really research what we believe are intrinsically undervalued businesses, regardless of industry or market capitalization. And we have, as I've been mentioned, two divisions. We have a research division where we sell our research on a subscription basis. And secondly, we have a money management division where we manage money for both individuals and institutions such as Mafre. First, I just really want to briefly discuss our research, as it's the engine that drives the money management train. We sell our research on a subscription basis to hedge funds, mutual funds, sovereign wealth funds, and family offices. These organizations rely on us to generate US investment ideas that are contrarian in nature. And a very similar business, and we utilize our research for this, is our money management division, where we utilize the ideas developed by our research division and create customized portfolios for clients with these ideas. So as I said earlier, the research really drives the money management train. And our investment approach, I think, is pretty unique. We're businessmen trying to buy the proverbial dollar for 50 cents. We look at every company that we invest in through the lens of an acquirer. What would a knowledgeable business person pay for the entire enterprise? That's what we're always asking ourselves. And it's been our long-held belief that if a company's share price sells at a significant discount to what it's worth over a reasonable period of time, either the stock market will reflect that company's true value, or an acquirer will pay for that business and hopefully will profit that way. And when I say a reasonable period of time, I'm not talking 2 months or 3 months. I'm talking 2 to 3, 4 years. So we're more patient than most. Barron's once called my father the world's most patient investor. And we truly are. We have that gift. And I think that gives us a competitive advantage. Investors and clients always ask, how do we come up with these stock ideas? And we have a variety of ways that we uncover, which I'm going to talk about in a minute. There's no magic formula. There's no proprietary algorithm. Everything is just deep, good old-fashioned stock market research. We run screens like everyone else can, but that doesn't really add any value. Anyone with a FactSet or a Bloomberg or Yahoo Finance can do the same thing. So we have to dig much deeper to add value for our clients. So one of the techniques that we use is the business value method. Oftentimes, Wall Street in its own way punishes entire sectors and throws out the baby with the bathwater. Wall Street really has this way of punishing an entire group where some companies are perfectly fine. So what we do is we look in and find those good companies, trying to find their competitive advantages, trying to discover what their long-term earning power is and their financial strength, and look at what similar companies have been acquired for in the not too recent past. And this way we're able to find that diamond in the rough. And that just takes a lot of work, a lot of patience, and being a contrarian. The next type of technique that we use is called the hidden asset approach. I'd say this is our favorite technique, as no computer screen in the world can replicate what we're doing. The only way to take advantage of this is reading through the company's financial statements. Basically what the hidden asset approach is generally accepted accounting principles requires companies to depreciate certain assets on their balance sheet that in fact increase in value over time. And we try to take advantage of this situation. The classic example I like to give, and this is in a well-known brand, was one of the first companies my father ever profiled in 1975 when he started the research service, was Tiffany & Company, the jeweler. Everyone knows who they are. And at the time, you could have bought the whole company. The enterprise value is $24 million. Can you believe it? You could buy Tiffany & Company for $24 million. But it owned the building on 5th Street and 5th Avenue and 57th Street, which is one of the most valuable pieces of real estate in the entire world. Even in the 1970s, that real estate was worth significantly more than $24 million, but because of GAAP accounting, it was depreciated on its balance sheet, and the company's stock price languished. We knew that wouldn't last for long, and a few years after we wrote it, Avon Products ended up buying Tiffany for significantly more than what we wrote it up for. We also love investing in great consumer franchises, especially when they're masked by a corporate name. A perfect example, and a company that's in the fund, is Acushnet. Most people, if I say the word Acushnet, or the company Acushnet, they'd have no idea what it is. But they own Titleist golf balls and FootJoy golf gloves. These are very, very powerful brands. And believe it or not, I know it sounds simple, but this leads to valuation discrepancy, because portfolio managers and analysts may see the word Acushnet and have no idea what it is and just pass it over, and you're able to buy stocks cheaper that way. I know it sounds simple, but it really does work. We also love looking at fallen angels, the once darlings of Wall Street that are now unwanted and unloved. Just like with the business value method, Wall Street has a way of making stocks soar to ridiculously high levels when a stock is in vogue. And when sentiment shifts, they punish them to equally ridiculously low levels. This is when we try to take advantage of the situation. We also like looking for special situations. They're a fertile hunting ground for us to find mispriced securities. We look at spinoffs, we look at post-bankruptcy reorganizations as we're able to find value that way. Just this past week, we were able to pick up shares of a preferred issue, QRTEP, which is preferred shares for Curate. And I'm not going to bore you with the technical details, but because of a technical reason, the stock sold off dramatically, and we were able to pick up shares on the cheap for the Mafre U.S. Forgotten Value Fund, or what we think are very, very cheap levels. Shares so far have recovered since then. So far it looks good, but it's still early days. And the only way we were able to react so quickly and have the time to do that was because of our in-depth research. Finding a cheap stock really is just the first step. If a stock is simply cheap, it could stay that way for a long period of time. You need a catalyst for capital appreciation. Otherwise, you can fall into a value trap. So my father has instilled this into me since I was young and into our whole team. Every time we come up with an idea, we must have a story. We must have a reason for the stock to go up over a reasonable period of time. And as I mentioned earlier, we're more patient than most people, and we can wait 2, 3, 4 years for this to unfold, because sometimes you're able to get stocks so cheap, you just have to be able to wait and allow the thesis to come out. So what makes us different? What makes us unique? What gives us our edge? And to me, it's really simple. It's our research. We've been selling research to highly sophisticated audiences for well over 40 years, 45 plus years actually now. And by continuously having to come up with ideas to such a smart audience and defending our thesis, I think makes us better investors, and it constantly forces us to come up with new ideas instead of just simply recycling our old ones. And another reason, that our competitive advantage is we go where others won't. We look for underfollowed names. We look for names outside the major indices. As I said earlier, great consumer franchises that are masked by a corporate name. And we think these overlooked or orphan or forgotten areas of the market offer a terrific long-term risk reward. And a little just about our team, because that's the most important thing, is, we've withstood the test of time. My father, Mark, started in the business in the late 1960s. He's still helping guiding the firm, but we have a great team. And we've been able to survive and thrive during some very, very difficult periods that destroyed many value investors, like the dot-com crash, the financial crisis, in 2008, 2009, and we intend to continue to stay in business and hopefully continue to thrive. We have a great team. It's a fantastic team of experienced investors who buy into our philosophy and are all value investors. They really eat, drink, and breathe value. And importantly, everyone is a generalist and is free to come up with ideas regardless of sector or market capitalization constraints. So they have the whole US market at their disposal. They're not pigeonholed into a particular industry, and that, we think, is an important competitive advantage. As I said earlier, research drives a money management train. We're very proud of our research track record. We utilize this research to help manage our clients' portfolios, and we think over time it really helps. So now I'm going to discuss some specific stocks, two stocks, both of which are very well-known household names that are currently in the Mafre portfolio that I'd like to discuss. The first name is CocaCola. which obviously everyone is familiar with. We came up with this idea in a recent issue of our research service and decided it was attractive enough to purchase for our clients. Coke is the largest non-alcoholic beverage in the world. What's an amazing statistic is Coke's products represent 2 billion of the 61 billion beverages served globally. I mean, that's amazing. 2 billion of the 61 billion served daily. They certainly have a large part of the market. Coke has quietly switched its strategy in multiple ways over the past decade, but because of a variety of reasons, the stock price really hasn't reflected the smart things they have done. It bought and then refranchised its bottlers, taking the company from an asset-heavy business to an asset-light business. This shift has really helped with margins, but the improvement has been masked by the strong US dollar. In addition, as you all are well aware of, the world is shifting away from its traditional sugary drinks. So now they are selling healthier beverages, and for their unhealthy beverages, they're selling them in smaller packaging to position them as a treat. This has aided increase margins substantially. The coronavirus has obviously impacted sales for Coke, but we think Wall Street is overreacting. The stock price is currently around $49. This was a $60, $65 stock pre-coronavirus. And we think much of these sales will eventually come back. It's just a matter of time. We think the operational improvements warrant a re-rating of shares and believe they're worth $66 per share, which would be about 45% upside if you included dividends. But even if their multiple stays the same, we still see about 30% upside when you factor in dividends. While the stock certainly could get cheaper, we think at these levels offers a very compelling risk-reward situation. The next company I'm going to discuss is another company every one of you, especially if you have children, are familiar with, Disney. My father always discussed how powerful the Disney brand was from an investment standpoint. But until I had children of my own and started to have to pay for all the Disney paraphernalia and trips, etc., I did not realize what he was saying. Now I do. Disney controls some of the world's best properties, from Marvel to Star Wars to ESPN, and of course, Mickey Mouse, Minnie Mouse, and Goofy. They've obviously also been impacted by the virus, but they have the balance sheet to withstand a shutdown of their business for an extremely long period of time, and we think their business will not be affected negatively in the long term. Prior to COVID, their box office performance was fantastic. They also bought Fox, bringing over to them even more fantastic franchises. However, what we're most excited about, and what actually COVID has been a plus for them, is Disney Plus. This is their new streaming system that they're rolling out worldwide. They had originally thought they'd have about 60 to 80 million subscribers by 2024. Well, less than a year from launch, they already had 60 million subscribers. And as someone with 2 children, it's the best $6.99 I spent. Utilizing a sum of the parts valuation, we get to $183 a share. And I think over time, this could prove to be conservative, as a Disney streaming service is very powerful. So I want to thank Zonavalue and Mafre, for inviting me to participate. I hope to be able to join you soon in person, and I'm happy to answer any questions that you might have. Thank you.
Yes, John, it's been a pleasure. And actually, yeah, I have a few questions here to throw you.
Sure. One second. I'm trying to find the Zoom.
Okay, no worries.
Hopefully you can edit this out, because I'm not finding it.
By my end, nothing has changed, so it's not a problem. Huh? You can leave it this way. By my end, nothing has changed. Huh?
Yeah. I apologize. I don't know where you went. Oh, here you are. There you are.
We can see each other at least.
Now we can see each other. That always helps. It's a little hard to hear you.
Yeah, I don't know. It's I think I'll try. Okay, so the first question, John. See if maybe if I change this. Wait a minute. Can you hear me better now?
Absolutely.
Excellent. So let's do it this way. Excellent. Okay, so I have a question. The first question is regarding, I mean, this kind of great consumer franchises. I take it that the dividend yield might be a factor to look for in these kind of companies. What's your take on this dividend yield factor? Do you think that dividend is a good thing to take into account when analyzing these kind of consumer franchises?
Absolutely. I think for any stock, not just consumer franchises, dividends are extremely important. If you look historically, the best performing companies have paid substantial dividends. And if you just invested in dividend paying stocks over time, you've done quite nicely, and it's money that you could put in your pocket. So I think, a case like Coke, which may take a while for the thesis to bear out, you're getting 3.5% while you're waiting, which is very nice in a world where interest rates are zero or even negative. To have this, these things, dividend at Disney, and they did a smart thing. They suspended their dividend during COVID just to conserve cash. But I fully expect once things go back to normal, they will reinstate their dividend. I think they want to make sure that they can survive.
Yeah. I have another question because you mentioned at the beginning that when you start researching, so you can screen the market, but then additionally you do this kind of in-depth analysis, of course. So what I see is, these kind of companies that you have shown us, CocaCola or Disney, I see that they are great companies and with high quality companies. So what type of first screening do you do? I mean, you run. First, you look for value, and then you add these quality ideas in the analysis, or you just do the opposite way around in the screening? It's just a curiosity.
That's a really good question. We don't have these screens. We do, of course, we run screens, low price to earnings, low price to book. But Disney, a lot of the stocks that we look at might not be statistically cheap. They might have these hidden assets, like a Madison Square Garden sports or entertainment, that the stock doesn't look cheap. But if someone was to buy the entire business because of the powerful assets they have, they pay a lot more for it than you would think. So, valuation is obviously extremely important, but there's more to it because there could be a lot more things if you look under the hood there. But, you of course want to start with low multiple companies, but if it's a cyclical business, you have to be careful. Sometimes it's better to pay a high multiple in a cyclical business because they're at trough earnings. So you have to take each individual situation on a case-by-case basis, and that's where I think experience and active management comes in. Just buying statistically cheap stocks, I think, could work, but I think you have to do a mixture of quality and looking at the assets.
Well, this is super interesting, this idea of combining value or the principles of deep value plus quality. Since otherwise the type of company, maybe it's just a low multiple, but not enough. And I have another question regarding with this, because what about this, for instance, these tech companies? Now we see that there are many companies that are spiking a lot, these tech companies, or this kind of innovation, disruptive innovation that is coming into the world. And these kind of companies, the tech companies, and what we see is that they're coming up a lot, but many of them might have a very, very high multiples, and another ones, they could have a low multiple. So what's your take on that? Do you think that a high growth company might be a value company also?
It could be. Years ago, we invested in PayPal, and it had these network effects that we thought were extremely valuable, even though it was selling at 40 or 50 times earnings at the time. So I think you have to look at it a case-by-case basis. Or one of the fund's holdings, Angie, ANGI is the ticker. It's one of the larger holdings in the fund. It's controlled by Barry Diller and IAC. That's a company that has a high headline multiple, but we think is building a great network. So I think you really just need to be careful. The problem with high multiple stocks is you don't have that margin of safety. If they make an error and things come down, they could, correct very, very deeply and very, very sharply. So you have to be really careful with them. But I'm not someone who's so dogmatic and saying, hey, I won't buy a high multiple stock. I recently wrote an article for Forbes. You can Google it. Value that doesn't necessarily mean cheap. So there are a lot of different ways to define value. And I think investors need to be flexible. I'm not switching my stripes. I am a value investor. I want to buy something as cheap as I can, but I'm also not afraid to pay up for something that is of quality.
Yeah, absolutely. No, actually, what I see is that over the years, what we see is there's a kind of value investing is kind of evolving, and it has to, because otherwise the world is changing. So we can see the things as they were 30 years back or 40 years back. I think something has changed and we have to adapt our methods. And especially this company, Boyar, long time in the market. So the experience is very interesting to see how you are able to evolve if needed. So this is super interesting, but keeping the same basis, the original basis. So this is super interesting.
Well, even if you look at Warren Buffett, I'm certainly not comparing myself to him.
Exactly.
He's evolved. He started as, Ben Graham was his teacher, who was a very, very deep value, just looking at statistically cheap stocks. And now Buffett has evolved that to having more of a quality bias. He happens to be one of the largest shareholders of CocaCola, for instance. But he bought that much cheaper than it is now, in fairness.
Absolutely. And what's your take on the current situation in the market? Do you think that this COVID is going to change? Because what I see also is that, there's kind of a debate between people that think that nothing is going to change and we're going to see things as they were, or that this innovative disruption that we see, this technological changes that we are facing, and the world is growing much faster and it's going to change much faster than it has changed over the last 50 years, for instance. So what's your take on that? Do you think that things are going to be the same, or something is changing and we have to adapt also to this new technological era?
You always have to adapt to new technology, whether it's from radio, when that was first introduced, to television, to cable, to other, satellites. The world is always changing. It's changing more rapidly now, but in different ways, and you have to be cognizant of that. But is the world, human beings going to fundamentally change? No. For me, people are still going to want to or have to go to the office. I don't think we're going to have a world where everyone's working from home. I think everyone's going to go crazy if they do. I think it's maybe a world where people now realize they can do more stuff from home, but there's still going to be need for office space and et cetera. So there will be changes, like there's changes in every cycle, but I don't think the world is fundamentally going to change. It's just going to be a little bit different.
Yeah, gotcha. And then my next question this is the last question that I have, that is, so what's your take on the value factor? Over the last 10 years, value has underperformed a lot, and we have seen like momentum factor or growth, it has spiked a lot. So there's now this moment where value might take over. This is one thing. There's a possible inflection point. And also this other idea that now I heard actually one of the speakers in this very event, and he said that over the last 10 years it has been great for beta, this kind of smart beta or indexing or something like that. But due to this situation and that value is super or has underperformed a lot, and this could be this change again. So we might see a good moment for active investment. Actually, now due to this situation. So, what's your take on this?
One, I certainly hope so. But
Absolutely.
as a value manager, it's certainly been a painful time to do what we're doing. Although up until this year, value investing on a relative basis may not have done well, but on an absolute basis, you did just fine. Any year where you can make 10% a year, for a long period of time, I take that. It's this year there's been a big dispergence in where value is actually gone negative. But I'm a big believer in mean reversion. I think the fact that value is underperformed for the past 10 years leads me to believe that value will outperform, or gives me greater confidence that will outperform going forward. I think if you buy, to me, it just makes sense. I've never understood anything else. If you can buy a basket of great companies, hold them for a long period of time, allow the magic of compounding to work, you should be fine. And you just need to stick to your style. Don't deviate. We've been there before. We were there in the late 90s when everyone called value investors dinosaurs, including Warren Buffett. They called him out of touch, and he's done just fine since then. And I see no reason why this time will be any different.
Yeah, absolutely. Actually, when you put it this way, it seems to be easy.
Nothing's easy. We'll talk in 10 years. Hopefully sooner. But we'll see.
No, but it's great. One thing that now, and this is very good for European people, in here, I mean, you guys there have this big industry with many possibilities, many different type of products. In here in Europe, we have also many possibilities, but we don't have this kind of possibility of investing with great investors like you. And now through Mafre, this idea, I encourage people to understand a little bit more about this fund and about your firm, because it's a great possibility for Europeans to buy a used fund in here. That easy in buying this this know-how, this long time know-how that it comes with all of you guys, and especially in your case with your firm. So, John, thank you. It's been a pleasure. Actually, yes. It's been a pleasure to have you on. And I don't know, I think this is, I hope we will gather new questions and new things, and we will be in touch, because you know that through the club, we happen to be in touch with you guys. So it's awesome. And if we can do this, and if we collect questions and stuff, and we can refer them to you, it would be really our pleasure.
Absolutely. Happy to help in any way. If anyone has any questions, our contact information is there. And you don't have to put this on the video, but if you want the copy of the slides, a PDF or anything, so you can distribute them, you're more than welcome to have
No, it's awesome. And actually, we could even tell, I mean, we could even put the slices for people to download. So it would be really great. So it's a good idea. If you can send it to me, we will distribute through the event. It's awesome.
Do you want it in a PDF or PowerPoint?
PDF would be great.
Okay, I'll send that. Thank you. Stay safe there. Be careful. And if you need anything else in the meantime, let me know.
Okay, John. So excellent. We keep in touch. Bye-bye.
Bye. Thank you.
Bye-bye.